President Trump's tariff and other policies are creating massive distortions in the U.S. economy. It hasn't been enough to push us into recession yet, but the warning signs are out there that we're heading into a period of great economic uncertainty. In today's video, we're going to look at the latest economic data to get a sense of what's going on. Let's get into it. Welcome to Real Estate Watch, the channel that focuses on forward-looking real estate and economic analysis. My name is Eric, professional economist and licensed real estate agent. Let's get right into the latest data and try to get our finger on the current pulse of the U.S. economy. In the first half of the year, real gross domestic product, or GDP, went on a bit of a roller coaster ride. In the first quarter of 2025, GDP growth was negative, the first time we had negative growth since the first quarter of 2022. And then in the second quarter, GDP growth roared back to an annualized 3.8% gain, the strongest quarterly growth since the third quarter of 2023. If we just look at these headline numbers, you might think we just stumbled a bit with that first quarter negative growth. After all, it was just negative 0.6%, but then the real strength of the U.S. economy showed up in the second quarter with that strong growth of 3.8%. But when we dig into the underlying components of GDP for those quarters, we can see the real culprit behind those numbers and why President Trump's tariff policies are creating massive distortions in the economy. We're looking specifically at imports. In the first quarter, imports made a negative 4.7 percentage point contribution to GDP. You see, imports surged in the first quarter as companies raced to build up inventories before the tariffs that were announced in April. In the government's calculation of GDP, imports are negative because GDP is intended to measure the goods and services that are produced domestically. So when imports surged in the first quarter, it caused a big negative contribution to overall GDP growth. If those imports hadn't have come in, then first quarter GDP growth would have been positive. When it comes to the second quarter, the opposite happened. Imports plummeted, which then made a 5.03 percentage point contribution to growth. Notice that this is higher than the 3.8% growth for overall GDP. So if it wasn't for that sharp drop in imports compared to the previous quarter, second quarter GDP growth would have actually been negative. So the first quarter GDP growth was negative, implying weakness in the economy, but this was because of a surge in imports to get ahead of tariffs, suggesting the first quarter GDP was actually okay. And then second quarter GDP growth was above average, implying strength in the economy. But this was because of a big drop in imports, and without that drop, growth would have actually been negative, suggesting the second quarter was actually weak. This is a pretty big distortion in the U.S. economy and makes it hard to gauge our current economic health. Another way we can see how tariffs have affected the economy is looking at business inventories. In the first quarter, a buildup of business inventories contributed 2.58 percentage points to GDP growth, reflecting businesses stocking up on goods ahead of the tariffs. But then in the second quarter, the change in business inventories made a negative 3.44 percentage point contribution to GDP growth, the largest negative contribution from inventories since the second quarter of 2020, showing that businesses have not been restocking their goods after that surge in the second quarter as they've been trying to avoid tariff costs. The craziness we're seeing in the GDP data has started to show up in other areas as well, especially the labor market. Over the last 4 months, non-farm job growth averaged just 27,000 jobs per month. For an economy the size of the U.S., that's pretty much zero job growth. In the 12 months prior to that, job growth was averaging 148,000 jobs per month, a considerable difference. To get a better sense of what is driving this significant slowdown in job growth, we can look at the major industries that make up the labor market. I ran the same comparison at an industry level, the 4-month average job growth between May and August, and then the 12-month average prior to that period. The industry with the biggest slowdown was the public sector. The average monthly job growth for government in the most recent 4 months was negative 12,500 jobs. But in the 12 months prior to that, average monthly growth was 24,000 jobs. Now you might say, that was all the Doge job cuts behind that, right? Well, yes and no. There was a big slowdown in job growth for federal government employment, negative 15,000 average monthly growth in the last 4 months compared to negative 1,500 in the prior 12 months. But there was also a notable slowdown in state government job growth, negative 8,300 average in the last 4 months compared to positive 8,600 in the prior 12 months. Another sector that could have been affected by President Trump's policies is construction. Average monthly job growth in the last 4 months was negative 2,000 compared to positive 10,200 in the prior 12 months. Construction is an industry that uses a lot of immigrant labor, and Trump's immigration policies could be playing a role here. What is also noticeable from this analysis is that every major industry, with the exception of utilities, which is pretty small, has registered lower job growth in the last 4 months compared to the prior 12 months. It's across the board and reflects the economic uncertainty businesses are facing right now. To make matters worse, we're flying blind to a certain extent due to the current government shutdown. The September jobs report wasn't released due to the shutdown, forcing us to look at other measures to see if the current weakness in the job market has continued. Private payroll processor ADP estimated that private sector employment declined by 32,000 jobs in September, suggesting the labor market remains very weak. But the news isn't all bad. Despite the weak labor market, third quarter GDP is shaping up to come in at a respectable growth rate. Consumer spending for July and August have grown at a 3% annualized rate over the first 2 months of the second quarter. That's an improvement over the 2.5% growth for all of the second quarter in consumer spending and the 0.6% growth in the first quarter. It's even more impressive given the weak labor market data for July and August. The Atlanta Federal Reserve Bank's GDP Now model is currently tracking overall third quarter GDP growth at 3.8%, on par with growth in the second quarter. We're in a pretty strange economy right now. The labor market is suggesting we are heading for a recession, but the GDP data is coming in pretty strong. The lack of new government data due to the shutdown isn't helping out much, as we can't see what the latest government data would show. But the totality of the existing data suggests that President Trump's policies in the short term are creating very large distortions in the economy, which could be causing great business uncertainty and might push us into a recession if it continues. It's not my intention to have a Trump bashing video here, but it's pretty hard to ignore what the data suggests is happening. Right now, the economy appears to be on shaky ground, especially from the perspective of the labor market, and there is a lot of uncertainty on where we're headed in the months ahead. If you want to stay up to date on all the latest in the U.S. economy, do all those YouTube things to keep watching this channel. Like, subscribe, hit that notification bell down below. And if you think there is something else going on in the economy causing all this that isn't related to Trump's policies, I'd love to hear about it in the comment section down below. Thanks for stopping by. I'll see you in the next video.